So what we are saying essentially here is that once the asset of the company equals the asset of the bondholders, then the company is nearing bankruptcy. So that's a key takeaway we can take from here. So it's very important for us to estimate the weighted average cost of capital. However, including debt financing in your capital structure helps to reduce the cost of capital. And the lower the cost of capital, the more profitable a business is. The more profitable, that's what we are saying. The lower the cost of capital, the more profitable is the investment. So essentially, the higher cost of capital, the higher risks of investing in that particular company. The lower the cost of capital, is the lower risks of investing in that particular company, and of course lower returns. However, it is more better to be on the safe side than that is why it's always important to include debt financing in your capital structure every one point in time, because it decreases the risks of the cost of capital. So let us move back to the control panel tab, and here we can set up some WACC assumptions we're going to be using to determine our weighted average cost of capital. So we know that we're going to be using the capital asset pricing model, and of course the cost of equity takes into account the risk-free rate, the market risk premium. It takes into account the country risk premium and other premiums such as the size premium and the country specific risk premium. So in this case, let us set up here these assumptions. So for the risk-free rate, it's gonna be 2.4% for the high and the low. This is based on a 20-year maturity treasury bill. So we are saying essentially here is that this risk-free rate is based on a 20-year maturity constant treasury bill, and also we will also include the equity risk premium. In this case, the assumption is 4.6% for both the low and the high, and this is coming from investing in stocks that earn a higher rate of return above the risk-free investments such as treasury bills. So if you're investing in an investment that is earning a higher rate of return greater than the risks of investing in a risk-free investment such as treasury bills, then we have the risk premium estimated here to be approximately 4.6% in the United States. And then we also have here the country risk premium, which we will consider that to be null. So it both applies for both the low and the high, given that Amazon operates in the United States. And we also have a size premium here of null, given that Amazon operates in many different industries. As we mentioned before, we have first party, we have third party, we have subscription services, we have advertising, we have cloud computing. So all of those different business segments contributes to the size premium of Amazon to be equal to 0. So it's like you're investing in the diversified basket of securities in different industries. So that's exactly what we are saying here. And then for the company specific risk premium, we decided to be equal to, for the low, 1%, and it goes up to 2%. So the country specific risk premium is the unsystematic risk, that is the risk involved in investing in a particular company or industry. So in this case, investing in Amazon alone will expose you to in will expose you to a specific risk of 1% for the low and 2% in the high case scenario. So that being set up, so essentially what we are saying here is that company specific risk involves investing in a particular securities as opposed to a basket of stocks. So invest in a particular security as opposed to a basket of stocks and bonds. So you are concentrating your investment in one particular company, and of course that just exposes you to a risk premium of 1% in the low and 2% in the high. And then the target capital structure, this is going to be based on our comparable company analysis for the debt to equity. So we're going to be seeing this later on, but we will set the assumption here to be 5% for the low and 10% for the high. So the total debt to equity, in this case, 5% for the low and 10% for the high. We will see this later on where we are constructing our WACC, weighted average cost of capital. So let us move to the weighted average cost of capital section here. And here we will be bringing in